2 years ago, Mike paid $1,800 in rent. Today, he owns a triplex, lives in one unit, and collects $2,400 monthly from the other two, covering his entire mortgage and utilities. How? With an FHA loan requiring just 3.5% down payment. Like breaking free from financial quicksand, you can stop paying someone else's mortgage and start building wealth through real estate, even with limited savings. I'm David Zai, and after 19 years in the mortgage business, I've learned that product, pricing, and speed matter most. Working with the world's largest wholesale mortgage broker, I can help you save between $8,000 to $11,000 over the life of your loan compared to retail lenders. Why do most people never get started? Have you ever wondered why only 7% of Americans own investment properties, despite real estate being one of the most reliable wealth-building vehicles? Well, the answer lies in the significant barriers that keep most people locked out of the powerful financial opportunity. Let's take a moment to examine what really happens here. When you want to purchase an investment property through traditional means, lenders typically require a down payment between 20 to 25% of the purchase price. For a modestly priced $500,000 property, you need $100,000 to $125,000 in cash just to get your foot in the door. This amount represents years of aggressive savings for most Americans, if it's achievable at all. Consider the realities for a middle-class earner. After taxes, housing costs, and basic living expenses, saving even $500 monthly would mean nearly 17 years to accumulate a down payment, by which time property values would have likely increased substantially. The financial hurdles extend beyond the down payment. Conventional investment loans demand a minimum credit score of 680 or higher, automatically excluding many potential investors, particularly younger buyers without established credit histories and middle-income earners who have faced financial setbacks. The debt-to-income ratio presents another significant obstacle. Conventional lenders require a debt-to-income ratio of 50 or lower. 43 is typically the mid-range, meaning all monthly debt payments, including the new mortgage, cannot exceed 50% of your monthly income. Even those with solid income often find themselves disqualified by student loans, car payments, and existing obligations. This creates a fundamental paradox in wealth building. You need capital to invest in real estate, but you need wealth to access that capital in the first place. It's comparable to needing experience to get a job, but needing a job to get experience. The timeline compounds these challenges. Research shows it takes an average American over 7 years to save enough for 20% down payment. That's 7 years of watching property values rise, missing rental income, paying rent instead of building equity, and delaying financial independence. These barriers disproportionately affect those who could benefit most from real estate investing: younger buyers seeking early financial security and middle-income earners looking to build multi-generational wealth. The traditional system keeps real estate investing primarily accessible to those already financially established. Fortunately, FHA loans offer a proven solution to these barriers, particularly when applied to multifamily properties. This approach significantly reduces the down payment requirement, relaxes credit score thresholds, and creates a more accessible entry point to property ownership. This strategy has been utilized by experienced investors for decades, but remains surprisingly underutilized by beginners who don't fully understand the multifamily advantage that FHA loans provide. You may be asking now, how do the numbers work? The secret to breaking into real estate investing isn't having money or more money. It's understanding how FHA loans can transform the math of property ownership. While conventional financing demands 6 figures down payments, FHA multifamily loans can get you started with a fraction of that amount, completely reshaping what's financially possible for the average person. Let's look at the mechanics behind what makes this possible. FHA loans are backed by the Federal Housing Administration, which provides insurance to lenders. This government insurance acts as a financial safety net for lenders, protecting them against losses and enabling them to offer dramatically lower down payments and more flexible qualification requirements. The contrast between financing options, like the difference between scaling a steep mountain or taking an elevator. On a $500,000 multifamily property, FHA loans require just $17,500 down, which is 3.5%, compared to $100,000 or more with conventional financing, accelerating your investment timeline by years. So this accessibility extends to credit requirements. Borrowers with credit scores of 580 or more qualify for a 3.5% down payment, while those between 500 and 579 can still participate with a 10% down payment. The minimum debt-to-income ratio of 43 also accommodates more potential investors than traditional financing. The multifamily component creates a powerful opportunity where FHA loans allow purchases of properties with up to 4 units with one stipulation: you must live in 1 unit as your primary residence. This house hacking approach is perfectly legal and central to the program's design. For 2025, FHA loan limits have increased substantially. 2-unit properties are $671,200 for standard areas, to $1,548,975 for high-cost areas, and for 4-unit properties, it actually goes to $1,008,300 for standard areas to $2,326,875 in high-cost markets. These expanded limits open doors to substantial investments across diverse markets. In expensive coastal cities, investors can now access premium multifamily properties previously out of reach, while in more affordable regions, these limits allow for higher quality properties with better appreciation. A practical example makes this concrete. A $600,000 triplex with a monthly mortgage payment of $3,800 PITI, principal, interest, taxes, and insurance, would generate $2,400 a month in monthly rental income with 2 units at $1,200 each. This reduces your effective housing cost to basically $1,400 a month monthly, often less than a 1-bedroom apartment. Every FHA loan includes mortgage insurance rolled into the loan amount, and this small premium enables the favorable terms, a worthwhile trade-off for beginning investors. Additionally, properties must meet specific standards through the FHA appraisal process, providing quality control that protects your investment from major unforeseen issues. This approach transforms the traditional home buying equation. So essentially, your home becomes a wealth-building vehicle where tenants help you pay your mortgage while you build equity in an appreciating asset. Your initial $17,500 investment can multiply significantly as the property values increase over time. So let's now talk about building that portfolio. While that initial $17,500 investment is impressive on its own, it's merely the first step in a much larger wealth building journey. Most new investors hit a roadblock when they discover a crucial limitation. FHA loans are designed exclusively for primary residences, and you can generally have one FHA loan out at a time. So this seems to create an impenetrable ceiling for growth. However, experienced investors follow a strategic pathway around this limitation, and I'll demystify that today. The foundation of portfolio expansion is the FHA seasoning period. The minimum time you must live in an FHA finance property as your primary resident, typically 12 months. Once you overcome this initial hurdle, 3 strategic options emerge to scale your portfolio. The first and typically most advantageous option is refinancing into a conventional loan. During the 12+ months of ownership, 2 forces work in your favor: property appreciation and mortgage payments building equity. When you reach approximately 20% equity, you can refinance, eliminating FHA mortgage insurance and freeing you up to use another FHA loan for your next multifamily property. Imagine purchasing a $500,000 duplex with an FHA loan. After a year, market appreciation increases the property value to $525,000, while your loan balances decrease to $470,000. With continued appreciation and the loan paydown, you can reach that crucial 20% equity threshold, unlocking your next investment opportunity. The second path is selling the property after the seasoning period and using the profits for conventional down payments or larger multifamily building. This approach sacrifices long-term holding benefits, but works well in rapidly appreciating markets or when exceptional opportunities arise. The third option involves renting out all units in your current property and moving to a new FHA finance property. This requires demonstrating legitimate circumstances for moving, such as family growth or job relocation. Consider Jennifer's journey. Starting with one FHA finance duplex, after 14 months, she refinanced into a conventional loan and purchased a triplex with a new FHA loan. By repeating this process, she built a portfolio of 11 units across 4 properties in 5 years. This approach creates a powerful snowball effect. Each property acquisition strengthens your financial position, rental income becomes documented on tax returns, helping qualify for future financing. Your growth experience as a landlord becomes increasingly valuable in lenders' eyes. Starting with that minimal investment, you transform from a homeowner with tenants into a legitimate real estate investor with a growing portfolio. The most successful investors approach this methodically, using each property as a strategic stepping stone rather than attempting to expand too quickly. Before I leave you, click the link below and schedule a time with me and my team. We'll personally develop a financing plan for your next home purchase, helping you start your journey with confidence and turning your investment goals into a reality. Accurately calculating all expenses are crucial for first-time investors. Beyond your mortgage payment, you must account for vacancy periods between tenants, regular maintenance costs, typically 1% of the property value annually, and capital expenditures. Depending on your property's age and condition, maintenance alone can consume 15 to 20% of your rental income. Your path to building wealth through real estate doesn't require massive savings or perfect credit. It requires understanding the right financing tools like FHA loans. Take action today. Research FHA loan approved lenders in your area, check current loan limits, and start analyzing 2 to 4 unit properties that fit your parameters. I'm David Zai, Mortgage Guy, and I'm out.